Welcome to our comprehensive guide on business valuation. Whether you're an entrepreneur, investor, or just curious about how companies are valued, this video will walk you through the essentials. Business valuation is the process of determining the economic value of a business or company unit. It's a critical step for mergers, acquisitions, investment analysis, and even succession planning. In the following scenes, we'll break down the key concepts, methods, and real-world applications of business valuation, ensuring you gain practical insights and a solid foundation. Let's start by understanding why valuation matters in today's dynamic business world. Understanding the reasons behind business valuation is crucial. Companies may need a valuation for many reasons: selling the business, attracting investors, securing loans, or even resolving disputes among shareholders. Each scenario may require a different approach or emphasis in the valuation process. For instance, a buyer might focus on future earning potential, while a lender may be more concerned with asset values. By knowing the purpose, you can tailor the valuation method to fit the situation, ensuring the results are relevant and actionable. Before diving into methods, let's clarify some key concepts. Business valuation involves terms like fair market value, intrinsic value, and investment value. Fair market value is the price a willing buyer and seller would agree upon, with both having reasonable knowledge of the facts. Intrinsic value reflects the true worth based on fundamentals, while investment value considers the value to a specific investor. Understanding these terms helps you navigate the valuation landscape with confidence. There are three main approaches to business valuation: the income approach, the market approach, and the asset-based approach. Each method has its strengths and is suitable for different situations. The income approach focuses on future earnings, the market approach compares similar businesses, and the asset-based approach looks at the company's assets and liabilities. We'll explore each method in detail in the upcoming scenes. Income approach estimates a business's value based on its ability to generate future profits. This method is popular for companies with stable and predictable earnings. It involves forecasting future cash flows and discounting them to present value using an appropriate discount rate. This approach reflects the time value of money and the risks associated with the business. It's widely used in investment analysis and merger. Discounted cash flow (DCF) method is a cornerstone of the income approach. It involves projecting the company's free cash flows over a certain period, then discounting them back to their present value. The sum of these discounted cash flows represents the business's value. DCF requires careful estimation of future cash flows, growth rates, and the discount rate, making it both powerful and sensitive to assumption. Market approach values a business by comparing it to similar companies that have been sold recently. This method relies on market data such as price-to-earnings or price-to-sales ratios. It's especially useful when there are plenty of comparable transactions. The market approach provides a reality check, reflecting what buyers are actually willing to pay in the open market. Asset-based approach calculates a business's value by adding up the value of its assets and subtracting liabilities. This method is often used for companies with significant tangible assets like manufacturing or real estate firms. It can be less relevant for service-based businesses where intangible assets like brand and intellectual property play a bigger role. Still, it's a solid foundation for understanding a company's net worth. Selecting the appropriate valuation method depends on the business type, industry, and purpose of the valuation. For example, tech startups may rely more on income and market approaches, while asset-heavy companies might use the asset-based method. It's common to use multiple methods and reconcile the results for a more accurate picture. The key is to match the method to the situation for meaningful results. Solid business valuation starts with accurate financial statements. These include the balance sheet, income statement, and cash flow statement. Each provides valuable insights into the company's financial health, profitability, and cash generation. Analysts scrutinize these documents to ensure the numbers used in valuation are reliable and up-to-date. Clean, audited financials build confidence in the valuation process. Sometimes, financial statements need adjustments to reflect the true earning power of a business. This could involve normalizing earnings by removing one-time expenses or non-operating income. Adjustments ensure that the valuation is based on sustainable, recurring profits, giving a clearer picture of what the business can deliver in the future. Tangible assets like brand reputation, intellectual property, and customer relationships can significantly impact a business's value. While harder to quantify, these assets often drive long-term profitability and competitive advantage. Valuation experts use specialized methods to estimate the worth of intangibles, ensuring they're not overlooked in the final calculation. Industry trends and benchmarks play a big role in business valuation. For example, high-growth sectors like technology may command higher multiples, while mature industries might see more conservative valuations. Understanding the broader industry context helps set realistic expectations and supports more accurate comparisons. The overall economy can influence business values. During economic booms, valuations tend to rise as investors are more optimistic. In downturns, uncertainty can lead to lower valuations. It's important to consider the current economic climate and future outlook when conducting a business valuation. A strong management team can add significant value to a business. Investors and buyers look for leadership with a proven track record, clear vision, and the ability to execute strategies. The quality of management often influences the risk profile and future performance of the company, impacting its valuation. Future growth prospects are a key driver of business value. Companies with scalable business models, expanding markets, or innovative products often command higher valuations. Analysts assess growth potential by looking at market size, competitive positioning, and the company's ability to capture new opportunities. Every business faces risks from market competition to regulatory changes. Assessing these risks is essential for accurate valuation. Higher risks usually mean a higher discount rate, which lowers the business's present value. Identifying and mitigating risks can enhance a company's attractiveness to investors. This market approach method involves analyzing publicly traded companies similar to the business being valued. By comparing financial metrics like earnings, revenue, and growth rates, analysts derive valuation multiples. These multiples are then applied to the target company, providing a market-based estimate of value. Another market approach method is precedent transactions analysis. This involves looking at recent sales of similar businesses to gauge what buyers have paid. It's especially useful for private companies where public data may be limited. Precedent transactions provide real-world benchmarks for valuation. Book value method, part of the asset-based approach, calculates value based on the company's balance sheet. It sums up assets and subtracts liabilities to arrive at the net asset value. While straightforward, this method may not capture the true earning power or intangible assets of the business. Liquidation value estimates what a business would fetch if its assets were sold off quickly, often in distress situations. This value is usually lower than going concern value, as assets may be sold at a discount. It's an important consideration for lenders and distressed business scenarios. Earnings multiples, such as price-to-earnings (PE) or EBITDA multiples, are commonly used in market-based valuations. These ratios compare the company's market value to its earnings, providing a quick benchmark. The choice of multiple depends on industry norms and the company's financial structure. Revenue multiples, like price-to-sales, are useful for valuing companies with little or no profit, such as startups. This method compares the company's value to its sales, offering a simple yet effective benchmark. It's especially popular in high-growth industries where profits may lag behind revenue growth. Choosing the right discount rate is vital in income-based valuations. The discount rate reflects the risk and opportunity cost of investing in the business. Commonly, the weighted average cost of capital (WACC) is used, blending the cost of equity and debt. A higher discount rate lowers the present value, reflecting greater risk. DCF analysis, terminal value, estimates the business's value beyond the forecast period. It's a significant component, often representing the bulk of total value. Terminal value can be calculated using perpetuity growth or exit multiples and must be chosen carefully to avoid over or underestimating the business's worth. Sensitivity analysis tests how changes in key assumptions affect the valuation outcome. By adjusting variables like growth rates or discount rates, analysts can see how sensitive the value is to different scenarios. This helps identify the most critical factors and provides a range of possible values. Valuing startups presents unique challenges due to limited financial history and high uncertainty. Methods like the Berkus method, scorecard valuation, or using revenue multiples are common. Investors often focus on growth potential, market size, and the founding team when assessing startup value. In mergers and acquisitions, valuation helps determine a fair price for both buyers and sellers. Negotiations often involve reconciling different valuation methods and perspectives. The process also considers potential synergies, cost savings, and strategic fit, which can influence the final deal value. Valuation is as much art as science, and there are common pitfalls to avoid. Overly optimistic projections, ignoring industry trends, or using inappropriate multiples can skew results. It's important to use realistic assumptions, cross-check methods, and stay objective throughout the process. We've covered the essentials of business valuation, from key concepts and methods to practical considerations and common challenges. Whether you're valuing a startup, a mature company, or preparing for a merger, understanding these principles will help you make informed decisions. Remember, valuation is a dynamic process that blends analysis, judgment, and market realities. Stay curious, keep learning, and you'll be well equipped to tackle any valuation scenario.